All right, thank you everyone for joining the Day Trade to Win webinar. As you know, if you've seen any of the webinars I've previously conducted, we try to bring you some good information, some good content, teach you a little something, and maybe it can help you improve your trading. Before I begin, what I want to do is make sure everyone is aware of the risks when it comes to trading. Please don't trade with funds you cannot afford to lose. Please be very careful. Talk to your broker. There is a risk of trading. You can lose all your money. You can make a lot of money as well, but you have to understand that there are risks when it comes to either forex trading, stock trading, futures trading, options trading. So please be very careful. Anyone have any questions on the risks of trading, just to make sure everyone's clear on this? If anyone wants to download a free simulator, if you go to DayTradeToWin.com, you're able to access a free trading simulator. This will help you in learning the methods. It'll get you accustomed to the trading platform, and you can also start understanding a little bit on how trading works. You can email me any questions you may have. You just have to fill out the form, and you'll be able to access either the free trading guide as well as the simulator. So we have a free trading guide to get you started. In addition, we have a new mentorship class starting on August 28th. So if you're interested in joining us, August 28th, it includes all the courses, all the systems, all the software, 8 weeks, and the training is recorded as well as provided to you. If you're interested more in one-on-one, you can also do that. The cost for the group mentorship class is accessible on the website. It's only a $500 deposit to reserve your seat. Usually these classes do fill up. So if you have any questions on that, please let me know. It depends, Key. If you're a client, there's no time on the simulator. If you're trying out uh, trading, understanding a little bit how it works, usually a month or two, I think is enough time for you to get the hang of it, and then you can move forward to see if there's something that interests you with trading. Okay, so we have a new class starting. I want to show you a few things that have been occurring lately in the market today, yesterday, this week. What I'm showing you here is currently the roadmap software. The roadmap software is only part of mentorship. I just have it up here. I was looking at it this morning because there was a signal. And so if those of you who are in the mentorship and have the roadmap, you can see that this is exactly the same signal to go short. Now, if I remove this software here from the chart, you're probably going to wonder, why would you enter short? What would be the target? What would be the stops? What is really the idea behind price action trading? I want to take out of the equation these indicators. All these indicators like moving averages, MACDs, they don't work because you have to optimize them. They never work into the future. If you instead focus on the price, the candles, the current environment, then it becomes more specific on why you're entering and how you manage the trade. So with all the videos that I have out on the internet, YouTube, there's probably over 400 or 500 videos now. You can probably see that I have this very important tool called the ATR down here. And this ATR, for those of you who have been following it for a while, you can see that the value is dependent on the market. So 2.69 that you see right here is dependent on the market. When the market's too slow, avoid trading. If the market's too volatile, you can also avoid trading because the risk is too much. So I use this ATR as a very important tool to tell me the current conditions at the time. We had such slow environment last couple of months that sometimes it's not worth trading. So you have to switch markets, or you have to look at a different time. Typically, if the ATR is above 1 point, which is about 4 ticks on the E-mini S&P, it's tradable. So what you're seeing here is a very good, healthy market. So volatility is back as per the webinar. Volatility is back. It could be because of the news events that are happening in the world. It could be any number of reasons. But it's like a cycle. Markets are slow at times, markets get volatile. The summer months are typically seasonally slower. So when you look at taking a target, taking a stop, always understand what the current conditions are. Because if your stop is smaller than 2.5 points, the E-mini works in quarter point increments, so I'm rounding down, then you can easily get stopped out because the market could either go up or down the equivalent of this value. So if your stop is, let's say, 1 point, right? Nobody wants to lose money, but if the stop is 1 point, the conditions are 2.5. So it's very easy for the market to knock you out of the trade as it goes up and down and up and down. And so the very next candle that's currently plotting, you can see that it went down. If your stop is too small and you happen to buy right at this moment, you may get taken out of the market unnecessarily. So it's important to understand it's not just indicators. You have to put a well-rounded idea of what are the conditions, what are my stops, what are my targets, what can I expect out of the market. Now for me, living in the Eastern Standard Time Zone, the New York time zone, this market opens up at 9:30, which is roughly right here. And what usually happens when the market opens is that the market accelerates. Everybody begins to buy, everybody begins to sell. There's usually a push. So one of the methods that I've created is what's called the at the open method with the software, the at the open 2. And the software is intended to be a once and done type of trade in the morning or in the beginning of the session, whether it's the European session or the Asian session or the US session, but typically there's a push. You can look at any chart, any stock, as soon as the bell rings, which is considered the day session, the pit session, it's almost as if everybody wakes up and begins to trade. And so the At the Open 2 software and the method itself can be purchased separately or it's included with mentorship, is intended to take one trade, either long or short, as the day begins. You have to be aware of the conditions. You have to understand what's happening. So even though I know that there's an acceleration as soon as the market opens, we still have to understand stops, targets, entries, management. You can see that the market is accelerating. Now, in addition, there are a few filters that I like to use. One of the filters happens to be not trading when news is about to pop because it's unpredictable. A news event is released, whether it's FOMC, PPI, unemployment, housing starts. Everybody buys or sells that market, which obviously throws a wrench into what the market is currently doing. So avoid trading right in front of or just before a news event because it'll unnecessarily be a big swing either up or down. So it's unpredictability I'm trying to avoid. Also, if you take a look at the market here, it's beginning to accelerate. Yesterday, we had a very strong ATR and a very strong volatile market as well. Think about how this cyclically works. You have grouping of days, 3, 4, 5 days in a row, where the market is typically very slow and tight, maybe choppy, range bound in a channel. And you also have consecutive days in a row with the same thinking that the market is volatile or has a high to low throughout the day that's very large. That has to be understood. You can't trade the same way when the market's slow or when the market's fast. So let me show you here yesterday. I'm going to add for example, the Atlas line here to the chart. And I'm going to add the ATO2 as well, which I have here on the chart already. So I'm going to add here the Atlas line. So these are all the DayTradeToWin indicators that are provided to you as part of the group or individual mentorship. And here are the parameters for the Atlas line. The Atlas line main signal is the one that I really focus on. The bounce trade I recommend for those of you who think about bounces off of support and resistance. I like to keep this unchecked because there's a lot of whipsaw when it comes to bounces. So instead of cluttering up the chart with text, I like a clean chart. I recommend everyone who has the Atlas line turn that off. The pullback and strength trades, as well as a couple of filters based on the ATR and so on. So when I click on this here, you're going to see that at the moment, the Atlas line hasn't yet plotted. So it usually starts in about 5 or 10 minutes showing you where the Atlas line and the signal. So we're going to wait to see that live. I'm going to also look at yesterday as an example Here is the Atlas line as well as the ATO. So the Atlas line started off here. Let me turn off the ATO too. The Atlas line started off here with a signal to go short. So this is the short signal here for yesterday. And at 24.59 quarter, it fired off telling you to go short. So you may wonder, why is this signal telling me I should go short? Why is it happening? Well, I don't like to keep surprises. I don't like to make things black box. I actually like to teach you the hows and the whys behind why you're doing and trading the specific method or the signal. The reason why this signal plotted is because the Atlas line is created from support and resistance. It's not optimized, and there's no value linked to it. So there's nothing that you have to optimize. It's based off the internal market itself. Whenever the market's trading below the Atlas line, your focus is short. Whenever the chart is trading above the Atlas line here, then your focus would be to go long. But it's not that simple. You just can't throw yourself long or short, because long or short doesn't mean it's going to continue. Long or short is a specific reason to enter into the market. And so if you're looking at why this signal appeared, it's two candles that happen to close below the Atlas line as soon as it started. Or into the future, if two candles close above, same idea, you're going to go long, and it's going to fire off a signal. You can definitely have a filter if you want, saying I don't want to see signals when the market's too slow, but look at this ATR. The market opened at 9:30, and what do we know about market opens? We know that it accelerates. Traders begin to buy and sell as the market or session begins, the pit session, day session. So I can definitely expect that the market begins to accelerate in the ATR, and the volatility is very high. So if you're looking at a specific stop, it has to be, without a doubt, as small as possible, but it can't be so tight that it's going to take you out. So I like to use a combination of stops in everything that I do. I don't like just one stop. If you have one stop, you're living and dying by that one price, either 1 point or 2 points or 3 points or 5 points. So having a specific stop that is going to take you out or is going to make a profit for you for a target, you're living and dying by those two numbers. Let's expand that out a little bit. Let's instead think, if I'm going short here at 24.59 quarter, why would I get out of the trade, or why would I take a profit? Well, if the conditions tell me currently that the market has been moving 2.25 points, between 2.25 and 2.5, but I think it's important to round down, then you can expect 2.25 points either up or down. If I'm looking to take it short, as soon as the market makes 2.25 points, that should be your target to get out of the trade. Or at least if you're thinking about trailing a stop under these more volatile conditions, you can trail a stop, then you should at least let it move to 2.25 points, because then it becomes a $0 trade for a break even, a trailing stop. So I know what my profit target is based on the chart, the market, and the current conditions. So these numbers aren't something that you constantly are optimizing. These numbers are set in stone based on what the market's displaying. In addition, if you have a stop, the stop has to be not just a catastrophic stop to get you out if everything goes wrong. I call it a catastrophic stop, but it could also be based off of time and based off of some type of proof or evidence. So if you enter short here at 24.59 quarter, which is the closing price of bar number 2, that's the reason why the signal actually is displayed and created, then what would get me out of the trade if it goes wrong? You have to think about, the trade may not work, and you have to get out of the trade. So time, some type of proof, and a catastrophic stop in the event everything goes wrong. So I like to use a combination of exit strategies to get me out of the trade. This is all explained during the training, whether the Atlas line training or just the group mentorship with which the Atlas line is included. It's explained. I don't like to hold trades more than 20 minutes, which is about 4 or 5 candles. I don't like to have large stops. I like to use stops large enough to keep me in the trade. So I know that my stop initially has to be larger than this because it could easily go up or down equivalent to this number. So it could go up 2.25 points or 2.5 points up or down. I'm never going to make this trade work if my stop is a point because it'll just take me out. The market will go up and down and up and down and take me out, and that's not going to help anyone. So what happens? The very next candle, the market goes down 2.25 points. That's your target. And the target was already known in advance based off of the current conditions. Now, not every trade is going to be a winner, so you have to be prepared if after 4 candles, if it doesn't make the trade, you exit the trade. It still could be a small win or a small loss or break even or almost the entire winner. So about 2.25 points, you're looking at a little bit more than $100 per contract, 112.50 to be exact. That's about 9 ticks. The more contracts you have, obviously, the more money you can make. I don't recommend you trading with 10 or 20 contracts. I actually recommend everyone start small and slow and grow. So I don't want anyone to think that you can be an instant millionaire. As you see, a lot of traders think that that's possible. It's only possible with experience and after a lot of practice and after a lot of losses and understanding how this works. So this is really a learning method, a learning process of starting slow and growing up to 2, 3, 4 contracts. It's not jumping in, betting the farm. We have to do this right. Now, the same thing with the strength trade right here. And the same thing with this pullback trade. These are some very specific reasons and methods for going short on strength, for going short on a pullback. But remember, the idea is only to focus when using the Atlas line on short trades or short signals. That way, you're filtering out any potential long trades that may go against the initial move or initial trend. These all have rules. It's a pattern based on what strength is. It's a pattern based on what a pullback is. And patterns can fail. So in addition to it being a pattern, it's also using a filter of price. So what does that mean, a filter of price? Well, I would say that if there's a strong trend, either up or down, or strong market for the moment, right? Because trends don't really last that long, or trends don't happen every day. But if there's a strong move, either up or down, you should expect every signal to be lower and lower and lower, or vice versa. If the trend is up, or if price is trading above the Atlas line, then you can expect every trade that you take to be higher and higher and higher. So I want you to think not just patterns, not just moving average crossovers, which this has nothing to do with, or MACDs or momentum or Bollinger Bands or Kellner channels, and all that stuff may have its place. I don't use any of it. I don't use Fibonacci's. What I do use, though, is a very simple idea that, well, if this is a strength trade to go short, how healthy is the trend to the short side? Is this entry lower than the previous signal? Well, in fact, it is, so it validates the trade. What about this pullback entry? Is this pullback entry lower than the initial Atlas line main signal? It is, so it validates the trade. So you're not just using a pattern. You're using a pattern, you're using a filter that says every entry is lower than the previous entry. You're also using this idea that the Atlas line only focus on the short trades below the Atlas line, long trades above the Atlas line. So you're using 3 things here to guide you through the trade. There's actually a 4th thing, overbought, oversold. I never like to take a signal or understand a trade that is overbought or oversold. Now, the rules are different across all methods. Overbought and oversold is basically saying, is this breakout, or is this trade I'm about to take, or is this bounce, or is this pullback, is it done? Is it already made 2, 3 points, and now I'm going long or short as the last guy or gal, long or short? So you have to have an understanding of, is the market overbought or oversold? If I look at this specific pullback signal, And if I look at this specific strength trade signal, I'll tell you from experience, this is much riskier than this because you're entering right as the market is beginning its new leg of a pullback down. This signal, on the other hand, even though it worked out and even though it was successful from here to here, market still made a good move to the low side. We don't know that in advance. Just looking at it as it's happening is risky. Whenever you see a big move that happens in a short amount of time, don't expect it immediately to continue and follow through. As opposed to this pullback signal, much better. You're entering right as it's pulling back and beginning its new or continuing leg down. Much better signal to take. So even though this signal was successful, the goal is not to take every signal. The goal is to pick and choose the best signals that make the most amount of sense. I would much rather take this one over this one for that reason. It's not oversold or over exhausted. This one could definitely be. The same thing with this. If you look at this signal you're entering, this is definitely lower than the previous strength trade. So again, the price filter validates. The pattern validates. And what about overbought and oversold? Definitely looking good to me. This is not, we're not entering after a large red candle has plotted. So essentially you're late to the party here. You're entering right as it begins its new move down. So all these things, if you think about it, common sense goes a long way, but then you put rules to this common sense. What's my stop? What's my target? Why am I entering? Why am I exiting? Let me focus now on the chart that we're going to see here, which is in about a minute or so. The Atlas line is going to plot, and you're going to see a signal either to go long or short. Actually, it happens to be long. So 2440 long is the entry. That's it. There's no ifs, ands, or buts about it. It's 2440 long. Now, let's manage the trade. If I do go long, what can I expect out of the move? Who knows? Based on everything that I show you and I teach you, what can you expect out of this trade? What do you think? Well, look at the current conditions, 3 points. So that means I can expect the market to move up or down 3 points from where it closed. 2443 should be your target. It's simple, it's direct, there's no fluff about it, and it's objective. That's the target, 2443, based on the signal the outline just provided. Anyone have any questions on this? Is it clear to everyone? Any new traders in the room? Do I need to go over some basics with you? I'm happy to. Now, in the same place, let's say this trade fails, doesn't work. How do you get out of the trade? I don't think any trade should really be held for hours on end, with the outline about 4 candles. So this being 1, 2, 3, and 4. At the close of the 4th candle, which I consider a time-based stop, you're out of the trade. If it doesn't work, you gave it more than enough time. Now the market's doing something else. It's on a new leg of its journey. It could go up later. It could go down. It could do something else. But don't hold on to trades in the hope that it's eventually going to work out. If it doesn't work out, if it doesn't hit your stop, you're out of the trade. Now, in addition, let's say that the market gets slower, which it could, or it increases. A great way to manage trades, especially under these more volatile conditions, think about adjusting your target and adjusting your stop if the market slows down. So right now it's 3 points. If the market begins to consolidate and tighten up a little bit, this may drop to 2 3/4 or 2.5. Well, that's easy. I know why I'm adjusting my target. It's based again off the current conditions. If it can't make 3 points, which is from here to here, like this, right there. Then I realize the market's slowing down and I adjust it to 2 3/4. It's always based off the current conditions. Okay, some questions here. Why is the outline giving a long signal before the ATO? Well, they're independent, Tom. The ATO is independent from the outline. They're unrelated. So if the at the open signal comes first, you'll see it. If the Atlas line signal comes first, you'll see it. So they're based off of different rules and methods. So sometimes the ATO comes first, sometimes the Atlas line comes first. It depends, Tom. Sometimes they come at the same time, as a matter of fact. Let me turn on the ATO 2 just to show you. Since I have it off, we can see if there's actually a signal on it. All right, so I have it plugged in. So there's no signal yet on the ATO 2. So the stop has to be based on these conditions. True has a question here. He says, where are you placing your stop if you're going for 3 points? Well, since I'm going for 3 points, that tells me that, first of all, the market's volatile. The stop initially has to be placed larger than 3 points. If I have a stop that's smaller than 3 points, look at how the market, let me just expand this out for you, True. You can see how the market went first down before it's now possibly going up, right? Possibly. How do I know that if my stop being a point or two won't stop me out only to see it now continue? So your stop initially must be larger than how it's currently trading or plotting. So for those of you who want small stops, you can use small stops as long as the ATR is at 1 or 1.5 or 2. You would use a stop larger than a 1.5 or larger than 2, but you can't at 3 points use a small stop. So the stop has to be larger than the current conditions, basically to keep you in the trade. Second, if the trade doesn't work, now this is a strength trade now, if the trade doesn't work, at the end of 4 candles, time, you're out of the trade. In addition, if there's proof that the market completely fails and it's not going to work out in your favor, the prove it stop will also get you out of the trade, which is a closing price here on the opposite side of where the Atlas line is currently plotting. So there's a grouping of stops that I like to use to keep me in the trade, to get me out with proof, and based off of time. That way, whatever happens first, so there's no picking and choosing, whatever happens first, be as objective as possible and get it out of the trade, win, lose, or draw. So that's how we configure the stops. The target, again, it's based off 1 times the ATR. So if you look at the 3 points that I have here listed, and I look at now the ATR, which is right here, it says 2.95. 2.95 is telling me that, rounding down, 3 points is not, or it could make it, but 3 points at the moment is not something that I could expect. So True, for your question, or Tom, or Sam, or Key, what do you think the stop should be, and the target? Not so much the stop at the moment, but the target. So instead of 3 points, it should be 2 3/4 because the market has just dropped down. So now I'm going to drop it down to 2 3/4. Again, the reason why I'm doing it is not because it looks like or seems like the right thing to do. I'm doing it because the ATR has dropped down to less than 3 points. So 2 3/4, rounding down, is what I can expect, right? Does that make sense to everyone? Now, any trade that you take, you should never risk more than 5 points. So any trade that you take, max it out at 5 points for your catastrophic stop. Should never be more than that, ever. All right, anyone, any questions on what I'm doing? Everybody understand the rationale and the reason why you're adjusting your target because the market's slowing down, even by a tick? Now, when you look at orders, the type of orders that exist, the type of orders we have are limit orders, stop with limits, market if touched orders. They all have a certain place for traders. Stop orders for those of you who don't know, convert into market orders. A stop with a limit uses a combination of a stop as well as limiting the amount of slippage. The limit order is I want this specific price or better. So let me show you a DOM here, and let me give you a little bit more guidance on trade management, which is not really spoken about in these webinars. I always see everybody talk about target and stop, but what about managing the actual trade? There's something that happens, especially when the market is slower, where if you have, for example, here's my DOM, if you have a limit order to get you out here at 24.42.50, and it touches your target. It touches your target. But when it touches the target, you're not filled. So think about how the markets work. When this price is traded, there's 476 contracts waiting to be filled. If it only trades 5 or 10 or 100 or 400 or 300, not everybody's going to get filled. So if all these contracts are taken out, it goes to the next price. If all these contracts are taken out, it goes to the next price. So that's how futures markets and electronic markets work. It's called first come, first serve when you first place an order. And it's a zero-sum game. If your target is touched, whether it's scalping, whether it's the Atlas line or the ATO, if your target is touched, then you have to think about that price was tagged, it was hit. You should be out of the trade. One way to absolutely get out of the market is just close out the position at market, or an MIT order, which is called market if touched. The market if touched order basically says, it touched my price, convert it into a market order. Essentially, you're doing the same thing. You're saying, it tags my price, I want out. That's MIT, market if touched. It touches my price, you click the close button down here, it automatically closes out all your positions. You can front run the trade, which is placing your trade one tick in front of everybody else. It's called front running. And for example, if it touches 24.42.50, which is 2 3/4, now you can see it dropped down to 2.5. So your target should be now 2.5 points, where it started off at 3. It's now 2 3/4, and then the current candle is saying 2.5 points. If it touches that target, whatever the ATR, 1 times the ATR happens to be, close out the position. So many times you may hold out for it to hit it again, or it may, you say to yourself, I want to see it go through it. But in reality, that may be the only attempt to actually touch that number or that price. So you just want to be proactive. You want to be able to get out of the trade if it touches your target. Don't think it's going to come back second, third, fourth time. It may or may not. We don't want that to turn into a loser. So trade management, think about it touched my target, get out of the trade. Everybody comfortable with that? Everybody understand? All right, excellent. Very, very good. So if this here hits 24.42.50, 24.42 please exit the trade. That's more than enough of a profit on a Friday morning, 2.5 points, 2 3/4 of a point. Okay. Now, if this signal is successful, the follow-up will be pullback, strength trades, bounce trades, maybe even short trades if it now drops and gives you a close consecutively below the Atlas line. You'll see all the signals throughout the day. But Fridays are kind of hit and miss, because if the market's slow, you can only expect it to get slower as the afternoon for Friday especially comes into play. All right, very good. Excellent. Took some profit? Good. All right, Manny. Have a great Friday. Nolan, any questions for me, Nolan? Frank, Donnie? So I would expect everyone to get out of this trade, right? We're not holding on unless you want to trail a stop or trail a target, but I would expect everyone to get out of this trade. This works in all markets, Donnie. This is not just for the E-mini. But again, it's relative, right? So every market that you look at, whether it's the euro or it's the crude oil, it has to be adjusted. You have to understand what the current conditions are right here for the market you're trading.